Hey everyone, welcome to the Life of PNK. I wanted to make a quick video and give you some guidance on how to save money. Actually, 3 tips on how to save money when it comes to purchasing a new home. I want to apologize for the echo. I'm in a different room. It's bouncing on and off the walls a little bit differently, so I want to apologize for the echo in advance. But let's get on with this video. And I'm not going to share with you the common things that other wizards or experts online say in their videos just to get views. I'm going to actually share some very useful tips that can help you purchasing a home, saving you a lot of money. Typically you hear, oh, buy an FHA, you only have to put 3% down, so on, do this, do that, purchase multiple properties, purchase like a duplex or something so people pay your mortgage. Nothing like that. This is personally going to be when it comes to closing costs and purchasing a home. So the first very important tip, and I believe that's one of the main things you guys should do is when buying a home, is opt out of escrow. And maybe some of you are going to think, what is escrow? Well, escrow is typically what the bank requires you to pay into account to where every month you pay, you keep adding to this account at the end of the year or annually, once annually, they pay the taxes for you through there or the insurance costs, the homeowner's insurance cost. So they ask you to have this money being part of your monthly payment. And what happens when you opt out of escrow? There's a couple of stipulations. First, you have to check with your lender. So every lender has different rules. They can also say, no, we can't opt out of escrow, but typically they want you to have a different loan to value ratio. Some lenders can, if you put 9% down, 10% down, I understand many people maybe not be able to afford that, but with the money that you're saving from opting out of escrow, you might be able to. It might be this breaking point. But typically, if you work with your lender, they'll tell you, we need you to put 10% down to be able to opt out of escrow. Some lenders are 9%, some lenders want 20%. So it just depends on the lender. You have to ask them. Those are good questions to ask when you're searching for a lender as well, to see what kind of options or how they can help you. But what happens when you opt out of escrow? You save on the prepaids and also you save on your monthly payment. And I understand you have to save money for those the taxes and insurance, but what I mean by you saving your monthly payment, you have a more flexible payment. So first, let's look at what happens when you close. At the time of closing, the lender might ask you to prepay your escrow for mortgage insurance if you have a flood insurance and taxes for 6 to 11 months. That can be anywhere up for like $5,000 to $10,000 that you have to put as prepays to fund that escrow account that the lender requires you to have. That $10,000 can be freed up to put more money towards the down payment, in the long run saving you more money. And one more small additional benefit that you can get from opting out of the escrow account is you can start budgeting the money yourself. So what happens is when you have an escrow account, the bank takes, like, let's say every month they take $800, $900 with the payment that the mortgage payment you send to the bank. They take that $800, $900, they put it in an account and it just sits there. You can do that yourself if you're very good with budgeting, if you're very good with following every month the exact rules that you have to put money aside for taxes and insurance. You can gain interest, and especially with the current environment in 2023, banks are on a savings account, banks pay pretty good yield. So you can make anywhere between $200, $300, $400 within a year, which will cover basically a monthly payment for your taxes or insurance premium. So opting out of escrow has multiple benefits that can help you down the line, and also will save a lot of money and reduce your closing costs by a good percentage. In addition to giving you more flexibility when it comes down to your monthly payment, because you don't have to pay that $800, $900 into escrow every month, your monthly payment is going to be that much lower. You can use that to maybe purchase a better home. I wouldn't recommend it because then you're getting even more into debt that you probably can't afford. By reducing the monthly payment, let's say 1 month, something happens where, let's say your car breaks down and you need to spend $1,000 fixing the car. You can have that available and catch up that on the back end the next month, instead of having to worry about how you're going to make your house payment and also how you're going to fix the car. So that gives you a little bit more flexibility, a little more freedom. And tip number 2 is very interesting. I had to learn a lot. It predominantly applies to people that live in Florida, specifically in flood zones. Living in a flood zone, it's not only in Florida, there's other flood zones by rivers and so on that people live in that, and they have to pay flood insurance. It's required by the lender. You have to get it. There's no options. The lender would not say, if you live in a flood zone, the lender is going to require this. They're not going to back down. So what you can do is actually do some research. You can go on FEMA's website and do some research about the flood zones. What flood zone are you in? And also look at something called letter of map amendment or letter of map change. And when you look at that, you can go to the website, look at the flood zone, and the flood zone is going to show, okay, your house is in the flood zone. Yes, but then look at the amendments that have happened. If there is a lot of recent amendments or even a couple years old amendments that are around your area where you're purchasing the new home, this is a good case to file for a letter of map change with FEMA. What does that do? Or what do you have to do to do that? You just go online, you fill out an application. It's free, actually. You fill out an application, and eventually you get to the end where FEMA requires a bunch of paperwork. They'll require like a plot map, a survey, an elevation certificate. They require all those key components. I believe it's about 5, but you can submit just a couple key ones. So you don't need all 5 of them or so. It may be depending on your area as well. So when you submit that, it's a long process. It takes anywhere between 30 to 60 days. So let's say you're purchasing a home, it might not have an answer until you close on the home, but that's okay. So let's continue with the steps. So you apply that, FEMA asks for those documents. If they need additional documents, they'll send you a message, which is really straightforward. You communicate through their portal, they send you a message, you submit the documents, and they come back with a result. Yes, your property, the actual land could be in the flood zone, but the way with the current building codes, some buildings might be a little bit raised from the actual land and so on. That's why they look at the elevation certificate. So then FEMA comes back and says the structure is actually not part of the flood zone. And this gives you the capability to tell the lender, hey, my structure is not in the flood zone. Please remove the flood zone requirement for my mortgage. And the lender has 2 things. They can agree or they can completely reject it. And I've not heard of lenders rejecting it because that's just on them, but they can be difficult like that. But typically a lender will say, they'll send a letter to your insurance agent saying, okay, this structure does not require flood insurance anymore, so please take it off. And then you'll get a refund. Yes, there'll be a couple fees that are not refundable for the state, which is okay, but you're saving anywhere upwards from like $2,000 to $3,000 depending how big your insurance is, your flood insurance, and that's a year. So that's more money, and if you have a long close, and you can save this insurance, you don't have to pay that, you can put that money towards your principal and get even a lower monthly payment. Not by a lot, but it saves you money. And you don't have to prepay the mortgage. Even though the FEMA flood insurance is prepaid a year in advance. So that's anywhere $2,000 to $3,000 that you've already paid because you had to have a bound insurance, but you're gonna get it back. It doesn't take that long to get it back. It takes about 2 weeks, I believe, via check. They don't give you a refund on your credit card or however you paid. They send you a check in the mail, minus the state tax non-refundable fees, and that's it. You get the money back. So I think that's a very, very key component. If you live in a flood zone, obviously if you live in a really flood zone that's really close to the water, it's probably not gonna happen, depending on how you build your structure. Maybe if you build it on stilts, but overall, it's worth the shot. It doesn't cost you any money. It costs you some time and some paperwork that you should be able to get from your realtor, from your lender, or from your title company. So it's not that terrible to do and organize. You just have to be on top of it. And once that happens, you're good to go. You save some money. So that was tip number 2. Let's go with tip number 3. And this one, it's highly debatable. In my opinion, I think it's worth it depending on how you play it. So with some lenders, in the current environment, believe it or not, they can give you a closing cost assistance. Sometimes it depends on what area you buy. If you're buying in an area that's like being under development, or it's kind of like outside of the city that's being developed, it's growing, you can get lender assistance. It can be anywhere between $5,000 to $10,000. It just depends on the address, the area code you're buying in, or the zip code you're buying in. But sometimes the lender, let's say they give you $5,000. Yes, you can use that towards your closing costs, which is going to help you a lot, and maybe put that towards your principal. But also you can buy discount points. So it can be really helpful where you can maybe reduce your rates by 1% in the long term of 30 years. That's going to be a lot of savings using the lender credit. That's going to be phenomenal. If you can do that, it's going to save you a lot of money. But a lot of people might say, oh, you should put that at a principal. It's going to help you more in advance by lowering your monthly payment and so on. I believe it has the same effect. You just have to calculate the break-even point. Typically, a break-even point is about 4 or 5 years, to be honest, which is about the normal time people stay in homes nowadays. But what you have to do is basically take the savings. So let's say you have your mortgage monthly payment, and then you have your mortgage monthly payment with the points. You subtract and you get the difference. So let's say it's $50, and then you take the 50 bucks, those savings, and see how many months you have to stay in the house to reach $4,000, $5,000 that you buy at the discount point. So let's say it's, I don't know, like $4,000. Let's do some like rough math. About 40 months. So it's gonna take you about 3-4 years to stay in the home to actually break even. So to make sense for your points. And again, I believe people stay in their homes for that amount of time before they decide to move somewhere because of life events, maybe like children going to school and so on, or maybe downsizing. Typically people stay 5-10 years in the homes. So buying mortgage points is going to be very helpful in the long term because you're reducing your interest, especially in the current environment. If you have the credit that the lender is giving you, take it and buy points. You can lower your interest by a good amount, a good chunk. And I do have a bonus tip for you guys and Ben as well. And this is going to be a very personal tip. I will say a tip that it's up to you to decide if you want to do it to lower your monthly payment. But you can have a personal belongings exclusion. So you can think about it this way. If something happens to the home, the insurance would cover the structure basically. And the bank is fine with that. As long as the structure is covered, the bank is totally fine. So you can exclude your personal belongings, like TV, couches, sofas, all your personal items. You can exclude that from being insured. That can save you anywhere between $1,000 to $2,000 a month, depending on what your insurance rates are. And I think, in my opinion, that's worth doing because in a long 30-year period, let's say, it's gonna save you a lot of money. Yes, it will be terrible if, like, let's say something happens to the house and your personal belongings just disappear or they get damaged, or I'm not sure if that covers vandalism or they get stolen. But it will be terrible, yes, that'll be terrible if that happens. But also, you're gonna be saving so much money that put like 250 bucks a month in an account and just let it compile every month. And then if something happens, just buy new furniture. Typically, a lot of people when they move, they buy new furniture anyway. So to me, including your personal belongings just adds extra cost to the monthly bill that you might be willing to, say, you know what? I don't care about my personal belongings in the house. I don't have that much stuff. I have a TV, a couch, a sofa. That's it. That's easily replaceable. You're saving $2,000 a month, which is really awesome. Yes, it doesn't include. Yes, if you have like gold, silver, whatever, yeah, that won't be covered. But also get a safe, or put it in a bank deposit box, something like that. With all that being said, I hope you guys enjoyed this video. I tried to make it concise and short, but I know I had a lot to say. I wanted to explain to you how you can save some money on your closing costs and your mortgage. I hope you guys enjoyed it. If you liked this video, if it was helpful, smash the like button. If you're new to the channel and just visiting, subscribe, and I'll catch you guys later. Bye!